SOFI is going to $4. Yes, that is exactly what some analysts are talking about. And in this video, we're going to explore why exactly these analysts say that, what are some of the risks involved, and how SOFI can potentially avoid this downfall. But as always, potential is a dangerous word, so let's dive in. Now, if you are someone who has followed for SOFI for quite some time, then perhaps you might have heard of this analyst, Giuliano, who has basically been bearish on SOFI for the longest time. Now, I have to say he actually does make some good points, and he basically released another report recently reiterating his price target of $4 per share for SOFI. Now, a couple of months back, right, he actually went on this podcast discussing his rationale behind his valuation model for SOFI. And so as I listen to it, I can actually understand where he is coming from. And when, he talks about his numbers and on the banking front, I can actually see, that his numbers are not fluff, and I can understand his conclusion. But I do believe that there are some logical fallacies in his argument. So what I'm going to do, right, I'm going to not make this into a long video. I'm just going to point out a couple of points that he actually made during the podcast that establishes his argument and offer the different perspective on it, and so you can make a more informed decision lah. And if you basically want a fuller picture of what he's saying, right, I will going to leave the link to the podcast down below. It's a very good listen. It's very insightful. It's about an hour and 30 minutes long, but the SOFI part is primarily the first hour or so, and then they end off talking about some other companies. So his first and most basic argument is that SOFI is overvalued on a price to tangible book value basis, and he compares this with Lending Club. Now, at the point where he was recording the podcast, right, SOFI was trading at $6.50, so it has changed now, and basically I want to take a look at what's the new valuation now. So for Lending Club, right, the tangible book value at the time of my recording is about $10.75, and it's currently trading at $12.50, making it 1.16 times tangible book value. In SOFI's terms, basically tangible book value is $3.92, and the current price is $8.50. So that means SOFI is trading at 2.16 times tangible book value. Now, basically Giuliano's argument is that, since they are both lending companies, why should they be valued differently? Even with the tech business, should SOFI really be worth double of Lending Club? Now, this is where I have to say, right, unfortunately, I really do agree with him. I think SOFI are shooting themselves in the foot right here with how slow they're scaling the tech business. Now, if they're onboarding clients at the same pace as Palantir are with their AIP program and things like that, then maybe some people can actually justify and argue that yes, they're actually worth double in terms of their valuation. But the fact that they're not doing so is basically putting an open target on their back. But beyond all of that, right, there's another reason that Giuliano himself actually gives later on, which I will point out. And this is the reason for the disparity in valuation, and this, argument is the fundamental difference in perspective. Now, additionally, he goes on from here to talk about how the tangible book value for both companies are not the same due to different accounting principles, and this is where it gets a bit technical, so I'm hopefully going to simplify it for you and not butcher it in the process. His second argument is very simply that SOFI's tangible book value should be much lower than it currently is because they are using fair value accounting compared to CECL accounting. Now, CECL accounting is basically short for, current expected credit losses, which is what Lending Club uses, but both methods of accounting are actually accepted by regulators, and banks and lenders are basically free to choose whichever method they want to use to value their loans. Now, CECL was actually only introduced as recently as 2016, but the main crux of the argument is this. Let's say I loan you $100, right? What Lending Club does is that upfront, they actually automatically recognize the expenses it takes to service the loan, as well as the possibility of default, and say that, this loan is actually only worth $92. However, in SOFI's case, when they originate the same $100 loan, they will take the loan and they will look for a buyer, and if the buyer is willing to pay $104, $105 for the loan, they're going to tell you that this loan is worth $104 and $105. And so the difference here is about $12 in the way of reporting, although they both originated the same amount of loan, which ultimately, according to him, makes SOFI's numbers looks a little bit more inflated. And so basically what he's actually suggesting is that we need to apply a lower multiple to SOFI and write off some of their tangible book value. Now, I know this is, probably not how he does it, doing some simple back of the napkin math with the numbers that he actually gave us in his valuation. Now, he actually says that, SOFI's tangible book value should be, around $2. And at the time of recording, SOFI's price to tangible book value is around 1.7, okay? When he was recording his podcast, not now, when he was recording his podcast. So basically, he's telling us that, the lending portion of the business should be worth about $3.40, right? Because the tangible book value is $2, you apply a 1.7 times multiple to it, that's $3.40. However, his price target for SOFI is $4, which means that the tech platform and financial services to him should be worth 60 cents. I don't know whether he actually realized this, but what he's actually implying by giving this valuation, at least from the way I look at it, is that he's basically saying that on a trailing 12 months basis, the other two business segments of SOFI that actually generated $960 million for the company is only worth $600 million. I'm going to say again, two segments of the business that generates $960 million for the company is only worth $600 million. That is the implication of his current valuation. So I've said, right, there's a couple of logical fallacies or problems that I have with his argument, and basically what I'm going to do is I'm going to tell you a very short story just to help you understand my perspective, and basically at the end of the day you can decide for yourself whether or not you actually agree with this valuation or whether there are some things in these valuations that you're actually having trouble accepting. So how I see this, broadly speaking, is basically in Singapore, right, when we're in secondary school, when you take a science exam, right at the end of the paper there's this open-ended segment. Now this open-ended segment is actually worth 30 marks and is made up of 4 questions. Now, how it works, right, is that the first 2 questions are compulsory. Everybody has to answer them. And thereafter, question 3 and 4, you basically pick one of the remaining 2 questions to answer. And what the teachers actually do is that they actually give you hints on the topics to focus on. They probably give you 3 topics to focus on. And my thought process when I was actually preparing for the exam is actually that, I will just study 2 out of the 3 topics, because the time that I spend to actually study the third topic can be better spent perfecting my understanding of the 2 topics that I'm going to study in. And one of the 2 topics will definitely come out. And even if it means, I don't have a choice at the end of the day in the exam, I'm perfectly fine with that, because I know that I'm so prepared for the topic that whatever topic that actually comes out, I'm confident in getting 10 marks for the topic. Now, why am I telling you this story? Now, if I were to sum up Giuliano's argument, it's basically this. He's saying that in the exam, yes, you may have gotten full marks because you answered questions 1, 2, and 4. However, if you are forced to answer questions 1, 2, and 3, you will not have gotten full marks because you did not prepare for question 3. So the question is, right now, is he actually wrong in saying that? Probably not, right? It's true, I did not prepare for question 3, and if I were forced to answer question 3, I would definitely not get full marks. However, the framework of the exam is that out of the last 2 questions, you can actually pick whichever one you want and answer that question. And so similarly, in SOFI's case, the regulators have already said that, there are 2 ways of doing accounting for your loans. You can pick either one. And right now, what happens is that Giuliano feels safer using CISL accounting, whereas SOFI is actually, optimizing their business based on fair value accounting, and he's using his valuation model to look at their business. And so for me, the argument is basically that SOFI has optimized their business to be valued using the fair value adjustment for loans. And so it's unfair to say that, but on a CISL basis, you should be worth $4. Well, yes, on a CISL basis, maybe they should be worth $4. But if they want to be valued on a CISL basis, then they will have optimized their business, right, to be measured in that way. So basically here are my arguments against it. Now, the first issue is that you have to hit the like and subscribe button right now if you have gotten any value out of this. Thank you for your time, and back to the video. Now, the real first issue or logical fallacy that I find with his argument is this. Now, he questions their profitability and their tangible book value because he uses CISL accounting instead of fair value accounting. However, back in 2022, when SOFI was awarded their banking charter, they had to show a path to profitability. Now, I'm taking this out directly from the OCC's licensing manual for charters. I'm not pulling this out of thin air. On page 8 of this manual, you can actually see that the OCC will only consider the applicant that can be reasonably expected to achieve and maintain profitability. Right, and if you scroll down on this manual, you realize that on page 22, it says that this applicant needs to show in-depth planning on how the bank is expected to achieve stable profitability. Not just any kind of profitability, stable profitability. Now, so what is this analyst implying? Now, I'm not actually saying he exactly said this. I think sometimes when we say certain things or we make certain comments, we don't realize the implication of our words, and I think that is exactly what's happening here. But his assumptions basically implied that SOFI's business plan wasn't reliable, and the OCC, the FDIC, and the Federal Reserve, all the authorities who actually need to approve SOFI's banking charter, all fell for their plan, right? They couldn't see that SOFI's business plan was unreliable and basically fudging their numbers. Now, alternatively, I want to reason that another possibility is that they saw SOFI's business plan and it worked, and it's basically within the legal framework that they have actually approved, and so SOFI's valuation model should account for SOFI's own proposed business plan rather than whatever business plan or whatever business model that he thinks they should have implemented. Now, Anthony Noto actually also explained that SOFI has been working on fair value accounting even before he came because they were primarily a lender and they cycled through their loan book pretty quickly, which means that, once they gave out the loan, they actually sold the loan to recoup as much of the capital as they could and then gave out a second loan within a short period of time and basically rinse and repeat. And because of that, fair value accounting works, right? Because it gives you an updated valuation of the loan because you're interested in selling the loan to willing buyers. CISO accounting, on the other hand, is actually more suitable for loans that are held for investment because it assumes that, you hold the entire liability of the loan and the whole servicing of the loan. And so in case of any defaults, you are the one that is liable for the loss. Now, that is not to say that there's completely no problems with the way SOFI does their accounting. Of course, it has its own risk involved, which we're going to talk about in a bit. Now, in the 22nd minute of the podcast, right, Giuliano basically tells us that he prefers using CISO accounting because it accounts for the expenses of the loan, whereas, in fair value accounting, you're always beholden to market forces. However, the thing is that 2 minutes before he actually made this statement, he actually gave a solution for this problem and he might not have realized it. So bear with me as I break this down a little bit. You imagine the loan of $100, which we were talking about earlier. If someone wanted to buy the loan for me for $105, then it's great, right? People can actually see that this loan is worth $105 and seeing that, all my loans are of similar quality, then it stands to reason that, my other loans are similarly priced and I can, apply that as the fair value of my loans. Now, however, the problem comes when SOFI cannot find someone else to buy their loans, and then they have to end up selling it at maybe $104 instead of $105, and they make less money. Now, this $1 less may not seem like much, but if we take a look at SOFI's loan book, it currently stands at around $15 billion personal loan, and so even a $1 drop in valuation of their loan, right, is a 0.95% drop. Now, it's not even a 1% drop, but its implication is quite big. So if you consider their $15 billion loan book, a 0.95% drop is basically a $142.5 million hit to revenue, which means that in the second quarter of 2024, let's say this had happened, right, they actually dropped by 0.95%, what will happen is that instead of recognizing $600 million in revenue this quarter, their revenue would have come in closer to $450 million. And so Giuliano is basically worried that SOFI will use this fair value accounting as a tool to cook the numbers and to keep attributing a positive fair value to the loans to inflate revenue while hiding the fact that the quality of their loans are actually pretty poor. But if you take a look at the numbers, right, you actually realize that in the first quarter of this year, in 2024, SOFI actually wrote down the fair value of their loans, and that basically should quell his fears that management just wants to use this as a tool to prop up numbers. And to me, the fact that they wrote down the value of their loans and yet still beat on revenue in the first quarter is particularly impressive. Now, secondly, SOFI actually argues, right, that this is a more transparent way of valuing loans by allowing markets to price the loans. Now, initially, I didn't understand this until I actually found this research piece by Michael Walker. Michael Walker is a CPA, and basically, he actually wrote about the benefits and the pitfalls of CISO accounting. Now, CISO, like he said, is not without its issues, and we actually find out that, in CISO accounting, you take the loss up front, so it feels safer, but there are actually a lot more assumptions involved in coming to this number. Now, the fact is that Michael Walker basically tells us that there's an elevated risk of management bias when it comes to CISO accounting, and we all know that management is prone to bias. I mean, you can't really blame them. It is their company after all. But basically, on this channel, we have always mentioned that potential is a dangerous word. And it's just that, Giuliano feels safe with lending clubs 7 to 8% initial write-off of their loans. And I think that this is just an arbitrary number. And basically, this paper suggests that, there could also be a possibility that lending club fares worse than this 7 to 8% that they are projected. And it's just because this is how people normally do it. So Giuliano feels safe, but it's not actually anything that is concrete. In fact, SOFI's CFO, Chris Lapointe, actually clarified that for SOFI's case, right, when it comes to their fair value accounting, it is not SOFI who values their own loan. They actually hire a third-party auditor that does it, and they report whatever the auditor tells them. Now, earlier on, I actually said, right, that Giuliano basically solved this problem himself. He has been worried that, through fair value accounting, SOFI are able to inflate their revenue numbers and things like that. And he actually gave us a solution earlier. At around the 20-minute mark, and I want to quote him here, he says that the lifetime economics or the lifetime accounting of a loan from a profitability perspective will be the same no matter which accounting methodology you use. End of quote. And if you consider, that Giuliano himself points out that SOFI's average loan duration is around 1.5 years, then, well, firstly, shouldn't there already be defaults? And shouldn't there already be problems with capital constraints by now? Which, obviously there hasn't been. And, if you say at the end of it, profitability is the same, then let's measure these companies and value them based on their profitability. Which means that if SOFI becomes a mature business, right, he's actually telling us that, hey, I'm going to give the same PE multiple as I do to Lending Club to SOFI. And if you consider that in 2026, SOFI aims to hit 55 to 80 cents of EPS, then SOFI should be valued at around $16.50 to $24 if you apply a 30 PE to it, which basically is a 39 to 68% CAGR. Perhaps even more if you want to, attribute it a premium for its tech platform and financial services and so on and so forth. So basically the last point of contention I have is that in the 26th minute, he actually pointed out that, he doesn't like to use price to sales ratio to value lenders, to value banks and things like that, because lenders can originate bad quality loans with high yields, but yet at the same time using this high yields to generate a high revenue. But because this revenue is backed by poor quality loans, right, it's actually not a good fundamental measure of the company. Now, this is where I want to point out SOFI is not just a lending company, okay? But many people still seem to think that way. But on this point, I think it's great because we are in agreement. The main disagreement here is that he's basically saying, the quality of loans that Lending Club originates is the same as the quality of loans that SOFI originates, which I fundamentally disagree with him. When you take a look at the average FICO score of Americans, right, it's around 715. However, the average FICO score of a Lending Club borrower stands at around 705, whereas for a SOFI borrower, that's about 745. And so if you think about it, one company basically has a customer base whose average FICO score falls below the national average, and a second company whose customer's FICO score is significantly above the national average. So to tell me that the both companies originate the same quality of loans is, well, a little bit disingenuous to me. And so to back this up, right, SOFI basically released their loan vintage performance recently, which shows that the last time a portion of their loan book actually hit the 8% default margin, right, was back in 2017 before Anthony Noto came on board. And the other loan vintages are performing better than this trend. So it definitely isn't true, right, that SOFI's loans are of poor quality and they are using fair value accounting to hide it. And if you ask me, when I take a look at, his assessment and his thought process, yes, the numbers he uses are fair, but that's only if you agree with the assumptions that he is making in his projections and valuation model. And so this is where you have to understand the bearish thesis around companies that you own and test your own conviction. And for me, I'm having a hard time to understand his thought process behind his assumptions, and my issues are not so much with the number he uses. And so if you have your own bearish takes on SOFI, please feel free to let me know down in the comments below, because for me, the concern has always been their slow growth of their tech platform and, this whole thing being just a missed opportunity and ultimately them being valued as really just a bank. This would definitely affect the valuation that I talked about in this video over here. But if you already understand my thesis of SOFI and then perhaps you want to look forward to their third quarter earnings, then I'll see you in the next one.